All right, well, I think we're going to go ahead and get started. So, welcome everyone. We are really very excited today to have this presentation for you, and thank you for joining us for our webinar. We're very excited that Terry Warfield will be presenting the accounting update, recent developments and involving issues. And we're very pleased to present this webinar as a member benefit of AFWA. And we do have a few housekeeping items that I'd like to go through real quick. And just to let you know, this program qualifies for 1.5 hours of CPE based on it's an hour and 15, I think it's an hour and 15 minutes of instruction with questions and answers. And to qualify for the CPE, you must be on the webinar for the entire time, and you must participate in all the polling questions. So CPE certificates and evaluations and the slide deck will be sent out within 1 week following the webinar. So you will get a copy of Professor Terry's slide deck. So I know sometimes that's a question we always get. So you will receive that along with the other information. And as a reminder, we encourage you to use the chat section to network with other attendees while the webinar is going on, and feel free to use this section to also ask questions for the speaker or other attendees. And we'll try to, at some point during the webinar, take a break. And if there are any questions in there, Professor Warfield will actually address those for you. And we also have a lot of material to cover today. So if you have questions, please write them also in the Q&A section. And we'll be answering those either during the polling break or at the end. So thank you so much again for joining us. And at this time, I'd like to introduce our speaker. Professor Warfield received a Bachelor of Science and MBA from Indiana University and a PhD from the University of Iowa. Professor Warfield's area of expertise is financial accounting. Prior to his academic career, Professor Warfield worked for 5 years in the banking industry. And from 1995 to 1996, he served as the Academic Accounting Fellow in the Office of the Chief Accountant at the U.S. Securities and Exchange Commission in Washington, D.C. While on the staff, he worked on projects related to financial instruments, financial institutions, and helped coordinate a symposium on intangible asset financial reporting. Professor Warfield served as one of 3 academic members of the Advisory Council to the Financial Accounting Standards Board from 2005 to 2009, and as a trustee for the Financial Accounting Foundation from 2013 to 2019. Professor Warfield's primary research interests concern financial accounting standards and disclosure policies, including the effects of accounting information and disclosures on securities markets. He has published articles in various scholarly and practice-oriented outlets, and Professor Warfield teaches intermediate and graduate level courses in financial reporting, and he has served on numerous PhD dissertation committees. He has received teaching awards at both the University of Iowa and the University of Wisconsin, and he has developed several case studies based on his research for use in accounting classes. These cases and related instructional articles have been published in issues in accounting education in the AICPA Professor Practitioner Case Development Program. Professor Warfield is co-author with D. Kaizo and J. Wygant of the Intermediate Accounting 17th edition, Intermediate Accounting Principles and Analysis 2nd edition, and Intermediate Accounting IFRS 4th edition. So please welcome Terry Warfield from my home state of Wisconsin. We are so delighted to have you here joining us. So at this time, I'd like to turn the program over to you. Thank you so much.
Thank you, Cindy. I think you got the long form of my bio. I'll have to abbreviate a little bit the next time. So thank you for that nice introduction. Good afternoon, or I guess it's morning for some out west. So I'm glad you can be here with us. A very nice turnout to listen to some of the thoughts I have to share with you about what's happening in the financial reporting standard setting environment. There was one question in the chat, Cindy. I think someone's calling in and they want to make sure they can participate in the polling question. So I think they can do that via chat if you're able to keep track of that.
Yes, they can. And for the chat, all they need to do is just answer the questions in the chat, and we'll make sure that they get credit for it.
Great. So I've done my share of housekeeping. let's get at the program. So here's the outline of what I want to cover today, and it's kind of jam-packed, but it's three broad themes. I want to help everyone understand kind of where we stand today with respect to international accounting. Secondly, I want to share with you some information around some recent standards that have been issued by the FASB, and they're kind of broken into two groups. And these are big standards, as we'll discuss. One group are standards where the FASB and the IASB have converged, that US GAAP and IFRS are now kind of, for the most part, the same. And then there's a couple of recent standards in the area of financial instruments and leases that they issued new standards, and they're different. And I'll hopefully give you some good insights about how they're different. And then finally, the last set is some discussion of other standard setting activity that the FASB has been engaging in, even though they've been very busy with these three big standards. The underlying theme here really is we're in a period of implementation of these new standards, and some deliberation around some new changes. And so for most of the people on this call who are accounting professionals, this is actually a good time where, if you haven't tuned into or been fully up to date on these various areas, hopefully my talk will give you some elements that you might dig in and learn a little bit more and increase your professional knowledge base. So let's start with a warm-up polling question. I'm not allowed to vote, but I'll tell you the button I will click is educator.
And we always forget to make it so the instructors can vote.
I don't feel disenfranchised yet, so.
Okay, good.
So whenever you want to move on, Cindy.
All right, we'll go ahead and end the poll.
Oh, really? Very, very nice mix of folks on the call. So again, hopefully I've targeted the talk to meet the needs of the people who are on the call. Okay, let's move on. Let's talk first about international. There's a little bit of pause on my slides advancing. Let me make sure. All right, now it's catching up. Okay, so this slide here is to give you a way to think about how international accounting conversations were happening, say, beginning about 10 years ago until about 3 years ago. And that model was a model where the FASB was working with other major standard setters actually to provide input and to collaborate with the IASB with an idea that maybe we could get to a single set of accounting standards internationally. And at that time, a lot of people thought that IFRS was a good candidate around which we might converge. And so this model is kind of the FASB, other major standard setters, regulators kind of providing or working up through the IASB. And so I want you to kind of just internalize that framework for a minute. That was kind of our old model. And what happened during that time is the FASB and IASB were working actually pretty closely together to see if they could develop a converged set of standards. And again, the idea here was to get to a high quality set of standards, not just to get to a single set of standards for convergence sake, but by working together, it was thought that the FASB and the IASB might come up with better standards than they would if they would have been working alone. So they actually dedicated a lot of coordination time, staff working together to see if they could find ways to narrow differences and actually arrive at new standards that would actually improve GAAP, both US GAAP and IFRS. And again, if they could make progress on that, this is the last idea here, that could potentially lead to the adoption of IFRS in the US. And again, this kind of happened beginning with the turn of the century for about 13, 14 years until just a few years ago. So that's kind of the evolution here. Then what happened? Well, we just didn't quite get there. And the US, for a number of reasons, some of this work was happening during the time when there was a lot of international upheaval. We had the financial crisis in there, and we had some change in presidents and change at the SEC. But for one reason or another, there was reluctance in the US to get on board with the IFRS bandwagon and to push back against potential adoption of IFRS. Now on this slide, and when you get the slides, you might want to click into this link I have here. The SEC actually conducted a study and they did an in-depth dive into what it would mean for US GAAP or US financial reporting if we would adopt IFRS. And what they found were some kind of troubling results. One is that, first of all, even though IFRS is a one set of standards, it's applied very unevenly around the world. Secondly, there's a lot of variability in how it's audited and enforced around the world. So even though it's one set of standards, the way it was implemented may not have resulted in consistent outcomes in financial statements. Third, there was concern about the independence of the IASB. They continue to be funded by people who actually use the standards. So there's concern that that funding might create a conflict of interest for the people on the board. The final bullet here is really important because this kind of established why we really haven't made progress towards adopting IFRS in US GAAP. And that is when the SEC staff dug in, what they discovered is that not only in financial statements, but GAAP net income or GAAP accounting numbers are found across many, many business settings. They're used as the beginning number in the tax code, that GAAP is referred to in many, many debt covenants, in various banking and insurance regulations. And as a result, if we would kind of flip that switch to go to IFRS, there would be a tremendous cost to kind of undo or unwind all those instances where a US GAAP number appears in those regulations. So as a result, kind of where we are today, let me go back one, where we are today, and this has been affirmed over the last few years, the SEC and the current SEC this is kind of where they stand. They kind of said, we're not going to adopt IFRS in any time near future. And as a result, they've kind of laid out some possible ways that there could be a path towards some narrowing of differences, and that would be by encouraging the IASB. I think everybody can move that question to the side a little bit. They can encourage the IASB and the FASB to work together where they can narrow differences. The SEC for public companies might develop a process for incorporating IFRS and US GAAP. And then finally, the FASB and the IASB have kind of abandoned kind of working closely together. And instead, the FASB is collaborating with other national standard setters to provide input to the IASB. So again, we kind of had some momentum around IFRS adoption. The SEC studied it carefully. Some events economically and politically in the US setting kind of put that on hold. And today, it doesn't look like we're going to converge or adopt IFRS anytime soon. So let's do our second polling question before I make the transition to what this means for accounting professionals.
Just as a reminder, you do need to participate in the polling questions to get the CPE credit. Right now, it looks like we got about 57 out of 63 so far. We'll give it just another about 30 seconds.
Okay, thanks for giving me your feedback on that. And again, the majority are kind of at the same spot where I am personally. I think they should work to converge where they can, because if they can, right, we can reduce the cost for users of financial statements. However, some of the issues that I raised on the prior slide, there's a cost benefit trade-off for preparers and other people who use Gaap financial statements for things other than just providing information to investors and creditors. So to kind of wrap this first part up, here's the path forward, right? We have kind of a multilateral model where the goal is to get to more converged or standards that are more alike, but not through any one standard setter. And the FASB, the ISB, other major market standard setters would provide input to that process. So what does this mean? So we've gone to this convergence to collaborations. What does it mean for accounting professionals? And what I try to remind people and my own students is that, even if the SEC never adopts IFRS, we're still operating in a global environment in which both Gaap and IFRS are being used. I'll give you a couple scenarios, and some of you may have experienced these scenarios. A number of U.S. companies have IFRS subsidiaries, or a U.S. company may be a subsidiary of an IFRS parent. So as a result, right, if you going in and auditing even a private IFRS U.S. company, you may need to know something about how the IFRS subs numbers are coming in to the financial statements, and vice versa. And I've had a number of my former students kind of come back after their first year on the job and say, gosh, I saw a lot of clients who had IFRS subs, and I had to dig into my accounting books to kind of learn a little about IFRS. The other place here is that some private US companies may wish to adopt IFRS because IFRS has a private company set of standards. And it looks kind of like US GAAP private company counsel alternatives, but it's a little bit more accessible. Some would say it's a little bit easier to apply. But the bottom line is all professionals need to be bilingual to some extent. And what I'd like to do now is talk a little bit about the extent to which we already are bilingual, and that's by looking at standards that are already converged, and then talk a little bit about some places where we're not converged, but that may lead to some standard setting efforts going forward into the future. So first of all, in that work program that the FASB and the ISB were in there, since 2002, leading up to 2016, the ISB and the FASB issued several standards that were converged. That is, they aligned US GAAP and IFRS. So I've given you a list here: share-based payments, accounting changes, exchange of non-monetary assets, business combinations. These are kind of big accounting areas, comprehensive income. And then, of course, fair value, the fair value framework and GAAP and IFRS are the same. And then most recently is the revenue standard, FASB ASC 606. And so the summary here is that there's a lot of alignment between IFRS and US GAAP already. So if you think about it, if you understand US GAAP in places like these where IFRS is pretty much the same, well, you already know about IFRS as well. And some of these differences that exist today may further diminish as the boards work forward. So let me give you some examples. These are kind of four of the big hitters where there are differences between US GAAP and IFRS that you might want to know about. The first one is inventory valuation. IFRS does not allow LIFO. And of course, as most people on the call know, LIFO is a very popular inventory method in the US, primarily driven by tax reasons, but that's not allowed in IFRS. Secondly, development cost. US GAAP pretty much has a strict rule about research and development expenses incur. IFRS actually has a framework where it allows some capitalization of development costs when projects meet economic viability. Agriculture. IFRS has a fully built out standard on agriculture, and US GAAP has various parts of US GAAP address agricultural assets, but not in a comprehensive fashion. So some people look to that IFRS standard as a way to get some guidance around accounting for agricultural assets. And then finally, convertible bonds. And again, the broadware area of financial instruments, and we'll talk about this a little bit later, but IFRS actually bifurcates convertible bonds when companies issue them between debt and equity. And US GAAP, when companies issue convertible bonds, it's all classified as debt. So these are kind of three kind of pretty common areas where there are distinct differences between US GAAP and IFRS. And they represent a place where US GAAP and IFRS, or the ISB and the FASB, might work together to address these differences, to narrow the differences between US GAAP and IFRS. So let me give you one more example that I really like to teach, and maybe some of you find interesting, and that's the accounting for pensions. Sorry, click too fast. One more, there we go. This chart kind of summarizes IFRS for the accounting for pensions. So on the left side, you can see the components of pension expense. And under IFRS, and this is as a result of a standard that was issued about 3 years ago, pension expense under IFRS appears either in profit or loss or in other comprehensive income. And you might say, well, that's kind of like US GAAP. Well, it is, but it isn't. First of all, the amounts that are captured in profit and loss is only service cost and only net interest expense. So only those two items are reported in income. All other remeasurements without reclassification under IFRS in a pension plan are classified or reported in other comprehensive income. So this is a much, much more simplified model of pension accounting than we have in US GAAP. And for those that spend a little time on pension accounting, you'll recall that if we have prior service costs or unrealized gains or losses in US GAAP, those unrealized gains and losses, prior service costs, get recycled back into income in subsequent periods. IFRS doesn't have that. They have a very simple model. Service costs, net interest income, expense goes into profit and loss. Everything else goes to other comprehensive income. A very, very simple model. And the FASB has begun to move towards this by allowing companies to report some elements of service cost and income and others in other parts of the income statement. But for the most part, the FASB has decided not to move towards IFRS in this regard. So this is an important IFRS US GAAP difference. This can be a big number in many financial statements. And it might represent a place where the FASB and the ISB might work together. And I'll come back to that later when I talk about the FASB's current agenda. So kind of stopping there just a minute before I switch to these new big projects. Again, a summary here, convergence efforts kind of have plateaued. The FASB's decided to kind of work on their own to improve US GAAP. At the same time, there have been 3 fairly significant areas in accounting that have changed recently. In the case of revenue, that was a converged standard. In the case of financial instruments and leases, there's a difference, and you might want to know about those differences. At a minimum, I think if you haven't dug into or spent some time in these new accounting areas, I hope the slides over the next few slides will give you some insight to the accounting for these areas. So let's first look at revenue. This is a big convergence milestone. And as a matter of fact, when the FASB issued the first iteration ASU around revenue back in 2014, which it had a very extended implementation timeline, a lot of people were very optimistic that if you can get revenue the same between US GAAP and IFRS, well, then that might suggest that we could get closer to adoption. And again, a few things happened along the way that I talked about earlier that got in the way of that. Revenue was a really important standard because it was identified as a big area that needed improvement in both US GAAP and IFRS. First of all, on the GAAP side, we had way too much revenue recognition guidance. And many times that guidance was inconsistent. You know, one statistic that the FASB would flash around when the project was underway was that there were over 120 instances of GAAP literature on revenue recognition. And again, when you had that many instances, boy, there can be no escaping some inconsistencies between how that guidance works. And actually, they had a lot of cases where many practitioners became experts in where revenue guidance might fit better with the number they wanted to report. And so, preparers would seek out the gap that they would want. In IFRS, it was kind of just the opposite. Their revenue standard was very general. And as a result, companies could kind of drive a truck through that standard and get whatever answer they wanted. So both the FASB and the ISB agreed that they could have some improvement here. And again, the goal that they set out was to remove inconsistencies and weaknesses in the existing revenue standards, to improve comparability of revenue recognition practices across companies. And if they could converge, it would also improve comparability globally. And then finally, preparers really welcomed a one place to look for revenue guidance. Many preparers found it quite daunting to dig around in the literature at that time to figure out answers to revenue questions. So here are the key elements of this new revenue recognition standard. First of all, the standard abandons what we all learned in intermediate accounting, that you don't recognize revenue until it's earned and realized. Or if you're an IFRS, it would be, have you captured the risk and rewards? Those are no longer primary recognition criteria, and I'll talk to you about how that changed in just a minute. Secondly, the model is based on analyzing revenue transactions based on contractual provisions. That's really important because this result has resulted in a standard that's very conceptually grounded in the definitions of assets and liabilities. Contractual provisions provide guidance on the assets and liabilities that arise as a result of a revenue transaction. Finally, this model is comprehensive. What happened when the FASB issued this is they essentially superseded all of the existing revenue standards that were industry specific. So as a result, it's a general model and it can be applied and accommodate sales of both products and services, because actually US GAAP was quite narrow with respect to the GAAP for service arrangements. And then finally, let me go back. The last point I want to make on what's different is that one more. My slides are kind of slow on this platform. Collectability, remember, earned and realized has been abandoned. Realized got at collectability. Collectability is not ignored in this standard. It's just not a criteria for the recognition of revenue. So on the next slide, which I love this chart because it gives you the whole revenue standard in one spot. First of all, within the standard, the FASB identified a key objective, and that is we want to recognize revenue to depict transfer of goods and services to customers in an amount that reflects consideration that they're going to receive, right, in exchange for those goods or services. So the key objective here is to kind of capture transfer of control from seller, from the company to the customer. Now, the way we're going to do that is now there's a 5-step process that we're going to go through to analyze any revenue arrangement. And I've laid the steps out here, and maybe some of you have implemented these steps, but we're going to start with identifying the contract. Within the contract, then we're going to identify the performance obligations that are in that contract. Next, we will determine the transaction price, and that's to take into account all the things that might affect the transaction price, rebates, refunds, expected returns, so on and so forth. And then if you have multiple performance obligations, which many arrangements do, we're going to allocate the transaction price to those performance obligations. And then finally, the 5th step is the recognition step. And there we recognize revenue when each performance obligation is satisfied. So contracts, performance obligations, measure transaction price, recognize revenue when performance obligations are satisfied. So that's the revenue recognition principle. And public companies have been implementing this standard for the last couple of years. We're beginning to see some financial statements that contain these new standards. So we kind of see how it works. Private companies are in the middle of implementing the standard right now. So they're still working through some of these and learning some lessons from what public companies have done. And I saw we had a lot of private company people or not-for-profit people on the call. And not-for-profits actually have changed their revenue recognition guidance a little bit as well. So let me give you a couple of thoughts on the new standard. For many, many arrangements, where we end up applying new GAAP and old GAAP is very, very similar. What's really new here is that the new standard is much more robust with respect to various complex arrangements and that we see occurring in practice. So that's sales with returns, sales with buybacks or refunds. And as a result, and sometimes what happens is liabilities are created when you have those buybacks. And under prior GAAP, those liabilities did not get recorded on company balance sheets. So in many cases, users of financial statements have really welcomed this new guidance because now they can see into the various assets and liabilities that arise as a result of contracts that companies enter into. So now with the new standard based on definition of assets and liabilities, this provides a great opportunity to kind of see how the conceptual framework definitions of assets and liabilities kind of play out in the revenue space. And remember, this is going to have pervasive impact on accounting across the financial statements. So it's not just about the revenue line in the income statement, but we're going to have some interesting and new accounting in the area of accounts receivable, inventory, and things like warranties. And then the last point I'll make here is that, and we're beginning to see this in company financial statements. One thing I would observe is if you look at the revenue disclosures under prior GAAP, they were quite deficient. As a matter of fact, revenue recognition disclosures under the prior standards were almost boilerplate and very, very uninformative. I'd encourage you all to go out and take a look at revenue disclosures for, say, Amazon or Target or retailers, different kinds of companies, and you'll see that there's a wealth of new information about the assets and liabilities that companies kind of put on their balance sheet as a result of revenue arrangements. So let me wrap up with revenue recognition here. We have our third polling question. Just watching to see if there are any questions in the chat. I think we're okay right now. So happy with the turnout, a great 68 people. That's a great group. So I'm really curious. Okay. So I'm so glad. I hope folks that are beginning to learn about revenue or have not done anything, I hope these slides have helped you kind of see the overall or the big picture and will motivate some further study. And then of course, some folks are just starting to get into it. So, so thanks for that feedback. So let's look at two other areas where, again, revenue is a big convergence area. And there's a few minor differences between the revenue standard under GAAP and IFRS. And actually, one thing that we've learned is that under IFRS and US GAAP, there are very different frameworks for interpreting new standards. And the FASB's been somewhat busy, IFRS, ISB, not so much. But I want to look at two other areas where we have some significant new accounting, but they didn't converge. So this slide summarizes three final standards in the area of financial instruments that have been issued here in the last 3 or 4 years and are just being implemented now. First of all is classification and measurement of investments. And you can see kind of the implementation guideline here. And that new standard has pretty well been implemented by most companies in the US. There's also been a recent standard on hedging to simplify hedging, maybe not very relevant to anybody on this call, but nonetheless, that's out there. And then finally, the most significant area here is the accounting for credit losses or the accounting for bad debts. And there's still some implementation happening on that. So let me give you a little overview of how GAAP changed. So for some of you, when you took intermediate accounting, you probably learned about classification and measurement under the prior standards. Well, today we have a different classification and measurement model. Not dramatically different, but nonetheless different. So first of all, this had been a big area of contention, and there'd been a lot of kind of back and forth and debate about whether we should have these three buckets for classifying financial investments. And everybody's familiar with the trading bucket, available for sale, and held to maturity. And of course, the problem with these three buckets is that they're based on management intent. So if management puts an investment into the available for sale bucket based on their intent, well, then they can avoid recognizing unrealized gains and losses in income, right? Because available for sale gains and losses would go through other comprehensive income. Or even more, if they choose the held to maturity bucket, right, but as their intent, well, then those are accounted for at amortized cost, and the gains and losses aren't recorded on the balance sheet, and they're not recorded on the income statement either. So the FASB and the ISB took a run at this in the early stages of these projects, and they proposed a model where all financial instruments, all investments would be classified at fair value with gains and losses through income. They got a lot of pushback, and part of that was this standard kind of got rolled out in the wake of the financial crisis, and a lot of banks and financial institutions would have taken a lot of big hits to income if they would implement this new standard. So the boards went back to the drawing board and essentially said, well, we're going to retain held to maturity, and we're going to retain available for sale for debt investments. So they kind of caved into the banks, in my opinion. They did it for good reason. There was a lot of political pressure, and sometimes the FASB and the ISB have to kind of pay attention to that political pressure. So we still have three buckets, and one advancement they did make was that today there is no available for sale for equity investments. So the available for sale bucket is only available for debt investments. So we got a little bit more fair value out of this new standard, and for the most part, banks and financial institutions are comfortable with this framework. And I think investors and creditors have learned to live with it as well. So that's financial instruments, classification and measurement. It's kind of converged. There's a little bit of minor differences on implementation, but for the most part, we did converge there. With respect to impairment or accounting for bad debts, this is a little bit different. And again, the problem here, and this problem was really highlighted and magnified in the wake of the credit crisis and ongoing other credit crises in the wake of the pandemic, let's say, is that our prior model for bad debt expense was based on the FAS 5. And that was a model where we only recorded losses for bad debts when there was an incurred loss. The problem with that model is that investors and creditors find out too late, or bad debts, too little bad debt expenses recorded too late. In other words, you don't find out about the bad debts until it's too late. When in fact, companies have really pretty good information about expected losses with respect to their receivables. So both boards agreed to an expected credit loss model that's sometimes abbreviated as CECL. And how they differed was how to implement it. So both boards agreed that we needed to get more future-oriented information into the financial statements with respect to bad debts. And so they abandoned the probable threshold that under US GAAP was in FAS 5. So what we do, and this is in the bold blue in the middle, at each balance sheet date, companies are going to estimate their allowance for credit losses. In other words, this is a kind of like a percentage of receivables approach, and they'll do that based on a current estimate of the contractual cash flows that they do not expect to be collected. And so this is kind of an expected cash flow measurement framework, kind of like concept statement 7. It's a single impairment model. We don't have a range of impairment models, which we had before. It is less complex, but it requires a bit more judgment because you're going to have to put some estimates on uncollectability out in the future. Now the FASB, that's the FASB model. So current expected credit losses, again, percentage of receivables, come up with an estimate of what should be in the allowance, and then the bad debt expense is going to be whatever you need to put in the allowance to get to that estimate. You're going to kind of true it up. And again, a lot of companies might have been using some percentage of sales approach. Well, that's really not appropriate under this model. You should always be looking at the receivables that you have on the books and ask which of those receivables are not expected to be collected. And that's going to go into the allowance. The ISB kind of adopted the same framework. They just implemented it a little bit differently. And they did that in a way where they delay recognition. So they put all these the allowance into 3 buckets. And essentially that allowed, they kind of caved into the banks in Europe, in my opinion. That allows some banks to kind of delay recognition until there's a real big deterioration in credit. So this standard's not converged. The recognition criteria for bad debts under IFRS is a little bit more liberal than it is under US GAAP. Now I've got a couple of slides that you might find useful when they're sent out after the talk. And again, I'm just kind of summarizing the way the percentage of receivables framework works, right? So allowance for credit losses is a valuation account, right? We deduct it from the amortized cost of receivables or other financial assets. And the idea is the historical costs or amortized costs less the allowance, that's going to give us the expected amount to be collected. So that's our model, and that's laid out in the ASC 326. So that's the credit loss model, CECL. One additional element of this is that, and kind of like revenue, the FASB really enhanced the disclosure around credit losses. And so here on the left side of this slide is the prior disclosure, which was pretty this year, last year, kind of credit grade, right? Under the future GAAP, right, we have what we call a vintage disclosure. So this is a 5-year historical disclosure of how loans move through different credit loss buckets. And we call this vintage, right, because the vintages over different periods, that tells us a lot about changes from historical trends. And that's really what investors told the FASB, that they need information like that. Now, some who have some experience with insurance accounting, insurance companies had been doing vintage disclosures like this for quite a few years with respect to payouts on their insurance policies. So this is kind of the same idea. By seeing how bad debts move through these various vintages from low risk to high risk, right, then investors and creditors get a better sense of the quality of the loans that the company's holding. So before I jump to leases here, a quick summary on financial instruments. 3 elements. I did talk about hedging, but classification and measurement. There's been a change there. We no longer have available for sale for equity security. But the new GAAP is pretty much the same in terms of fair value on the income statement, on the balance sheet. You might have amortized cost or fair values going through income or equity, depending upon where you classify debt securities. CECL is a big new standard, a new way to measure the allowance for doubtful accounts or bad debt accounting. And again, the CECL standard is just will be implemented by private companies next year. So it's still being implemented. So there's still some time to learn about this standard and how you would implement it. And I'll talk a little bit about some of the resources the FASB has to help companies, auditors, other of their stakeholders to become informed about these standards. So let's move on to the next big of the big 3, number 3 of the big 3. And that's leases. Leases, or the accounting for leases, really got a lot of attention, actually going all the way back to Enron. If people can remember back that far, I've been around long enough to do that. And actually the SEC did a study of off-balance sheet financing. And at that time, that study found that leasing was the biggest source of off-balance sheet financing on most companies' financial statements. And as a result, there was a big chunk of obligations and assets not appearing on balance sheets. And this was perennially identified as an area where GAAP and IFRS needed improvement. So in the FASB and the ISB worked hard on this together. They got to final standards back in 2016, and there have been some amendments to the standard since. It's just being implemented by private companies this year, going into next year. So public companies have adopted these new standards, and the FASB again has issued a couple of updates to ease implementation for some people. So let me explain this new standard. It's not fully converged. A good part of it is converged, and that's a good thing, because one thing the new standard under GAAP and IFRS has done is to make sure that all leases longer than 1 year are recognized on the balance sheet. So let's take a look. First of all, an overview of the provisions for lessees and lessors. First of all, for lessees, we now have a right of use model that we're going to implement under which all non-cancelable leases longer than 1 year will be capitalized on the balance sheet. That means the asset that you control by virtue of the lease and the promise to make payments over the lease term, those amounts be recognized on the balance sheet. And so again, what's a little bit different here is that this model allows lessees to account for part of an asset that's covered in an operating lease. So that means lessees record an asset for part of an asset it controls, and it records a liability for the obligation to make payments to have control of that part of that asset. Now, classification is still important in this model under US GAAP. That's because the accounting for lease expense is going to be different depending on whether you classify a lease as a finance lease or an operating lease. So let me highlight that point real quick. First of all, if you'll remember from your prior GAAP knowledge, the classification was between capital leases and operating leases. The capital vernacular is gone. So now there is a classification between leases, but it's finance leases or operating leases. And we have five tests that we're going to look at to determine that classification. Now, here's the key. Income effects for the lease, if you're a lessee, depends on whether the lease is classified as financing or operating. If it's a financing lease, we're going to use effective interest amortization just like we did before for capital leases. For an operating lease, we're going to record straight line lease expense. And what's different here is that straight line lease expense results in an amortization of the right of use asset that we have to amortize over the life of the lease. So I'm going to explain that in an example in just a minute. So that's lessees. All leases are capitalized now, assets and liabilities for part of the asset or the whole asset that you control. And classification has a consequence or is important for how you're going to recognize lease expense. Now for lessors, new GAAP is pretty much similar to old GAAP. We're still going to have operating and sales type or finance leases. And one little difference here is the sales type lease provisions where you're using the lease to sell a product, right? That now aligns with new revenue recognition guidelines. But for the most part, lessor accounting is quite similar to prior GAAP. And again, IFRS is similar, but they have a different model for expense recognition. I'll give you a real brief peek at that. It's real easy. They account for all leases as finance leases from an income standpoint. So let's talk about classification, pretty much like it was under prior GAAP. So, but now we have, instead of four tests, you may remember the 4 steps, 4 tests. The first 4 bullets here, and these are applied similarly for lessee and lessors: transfer of ownership, purchase option test, lease term test, present value test. Those are exactly the same as prior GAAP. The FASB explicitly added an additional test called the alternative use test. And the alternative use test kind of says, well, if the lessee doesn't have any, the lessee doesn't have an alternative use for the asset at the end of the lease, then the lessor expects to get it back. Or the other way to go, if the lessor doesn't have an alternative use, then they assume that the lessee is going to take it at the end. So ownership transfers. So if any of these tests are failed, right? So there's a transfer of ownership. Well, if there's a transfer of ownership, you got a finance lease. Or if there's a purchase option where it's likely that you're going to purchase the asset at the end, well, that's finance lease. That's just like prior GAAP. Alternatively, if none of these tests are met, then you have an operating lease. Regardless of that set of tests, right, all leases longer than a year are going to be capitalized. So these tests have no effect on whether you're going to capitalize the lease or not. They only have an effect on the expense recognition. And we'll talk about that in an example in just a minute. So here's an overview of the model. Lessor's required right of use asset at lease commencement, right? There's a single lease expense model for operating leases. I'll summarize that in an example in just a minute. And the single lease expense we'll see is the sum of interest on the liability. And then what's new in the new standard is operating leases, there's a right of use asset. We need to amortize that to zero over the term of the lease. And as we'll see, that amortization is a plug, and that's how we get straight line expense for operating leases. So that's a kind of a preview summary slide. Let me give you an example. I'll leave this slide up for 30 seconds so you can kind of internalize the facts. So this is an operating lease example where Josway Company grants right of use for one of its cardboard compactors to trailer stores. This is the example we have in our text. The lease term is 3 years, right? The lease payments are non-cancelable, require annual rental payments of $17,000 and some change. The present value of those payments is $49,925. The compactor has a cost and fair value at the beginning of $60,000. Kind of pay attention to these relationships. So the present value of the payments is less than 90% of the value of the compactor. So that's a 90% test, right? And of course, the lease term is 3 years. The expected useful life of the assets are quite a bit longer than that. The lease contains no renewal options. The compactor goes back to the lessor at the end of the lease, and all these other facts. Bottom line, you look at these facts, none of the 5 tests are met. And as a result, this is going to be classified as an operating lease. So then how do we do the accounting? Well, let's do day one accounting. Day one, right? Trailer is going to record a right of use asset for the present value of those lease payments, and they're going to record a lease liability for those payments. So they get this asset, they promise to make these payments. And then this is an annuity due, so they're going to make a payment on day one. Here's the amortization schedule for the liability. So we're going to have 2 amortization schedules. One's for the liability. So every year there's going to be a lease payment, and each year, right, the lease liability is going to be amortized, right, at using a 6% interest rate. So that first payment had no interest. The second payment has 6% on $32,000, and then the lease liability is amortized for the difference, so on and so forth. Takes the liability to zero. So I'll give the 10-second internalization. Now, this is exactly the same type of lease amortization schedule we would have for a finance lease, right? It would just likely have maybe more payments or a longer term. So the accounting for the lease liability between operating and finance leases is the same. That's the liability. What about the asset? So remember, I'm going to go back up. Sorry. Remember, at day one, we recorded on our balance sheet a right of use asset. That asset is viewed as like an intangible asset for the lessee. Well, now what are we going to do with it? We're going to use that up over the useful life of the asset of the lease. And here's how we're going to track the amortization of the right of use asset. So first of all, each year there's going to be straight line expense, which actually equals the amount of the payments, right? There's interest on the liability. We picked that up from the prior schedule. And then each period, we're going to amortize the right of use asset for the difference between the straight line expense and the interest liability, such that the carrying value of the right of use asset goes to zero by the end of the lease. So think about that for a minute. Amortization of lease liability, kind of the way we expect, right? The lease liability goes down to zero. There's lease liability shows up here again, and then the difference between the expense and the lease liability is the amortization of the right of use asset. Again, that's kind of a plug. We're going to plug that in so to make sure we get straight line expense. And then by doing that, by the end of the life of the asset, right, it will be amortized to zero. And here's the example what that entry looks like. So that's how we kind of tidied up accounting for the right of use asset and the lease liability for operating leases. And a couple of things, right? If this were a finance lease, right, we would have depreciated that right of use asset, right, over the useful life of the asset, right? Usually straight line, declining balance, whatever method we use. Here, this is increasing amount depreciation over the life of the lease. And I say, we don't usually do that in Gaap, you're right. But because this right of use asset is considered an intangible asset, it's okay to use increasing charge amortization or depreciation. So that's the big change between operating leases, between old Gaap, new Gaap. We have to now account for this right of use asset. This is a framework we use, and it links the interest on the liability to amortization of the right of use asset. Now, let me make a couple of conclusions about the new lease standard. First of all, think about what's going to happen to balance sheets. Balance sheets are going to get big because operating leases are quite common in our economy. So as a result, all leases other than short-term leases, one-year leases, are going to be on the balance sheet. That will increase or gross up balance sheets. And estimates have been for most public companies, it's been on the order of 10 to 15%. And when you do that, right, that will have an impact on key ratios and could have an impact on covenants. I'm going to make a comment about that in a minute. On the income statement, most equipment leases generally are capital leases or finance leases today. So that the gap didn't change much there, but to the extent that we have equipment leases that are operating leases, that's going to result in some front loading of expenses. And then, of course, income effects for operating leases actually is no different under current Gaap and former and Gaap before. You know, the income statement effects aren't that big. The big effects for this new standard are all those assets and liabilities coming onto the balance sheet. Again, under IFRS, we don't have to worry about that kind of funky lease expense model because they account for all leases the same using effective interest amortization of the lease liability and amortizing the leased assets over their useful life using whatever depreciation method they use. So last thing on leases, and I want to give the FASB credit here, and notwithstanding the fact that I was on the board of trustees when they issued this standard, but I thought it was a good idea what they did, is that, you know, they established a very long implementation window for this new standard. And the reason for that, the polling question is going to come up in a minute. The reason for that is the FASB went out and surveyed lessees and lessors to kind of get a sense of what was the kind of average maturity of most operating leases. And what they found was that the average term of most operating leases was around 2.5, 3 years. And so what they did was anticipating these issues about debt covenants and other issues that would happen with adding these liabilities and assets to the balance sheet. The FASB said, well, let's give a long implementation period, and that way those operating lease contracts can unwind, and then they can be when they mature and they have new lease contracts, they can take into account the new effects of the standard. And that's kind of how it's played out. There really hasn't been that much of an effect with respect to debt contracts, other contractual elements as a result of adopting this new standard. So let's have polling question 4, Cindy, if we could. And this is a question about new standards in general, kind of what's your approach to begin learning about new standards? Now, this is our last polling question. I hope you stay to the end because I got a couple of good slides for current activities. And we'll certainly have a few minutes for some Q&A if you wish when we get to the end. Did we get everybody in there, Cindy?
Yeah, I went ahead and ended it real quick here.
Good.
So you should see the results.
I kind of expected that, and I'm assuming everybody can see the results. You know, I clicked immediately upon passage by the FASB. You know, my co-authors and I have we've had quite a run here with all these new standards, kind of keeping up. And of course, instructors want to begin teaching these new standards as soon as possible. So we can't wait around. And of course, we are providing the educational resources. So hopefully you're able to kind of track down some resources in that regard. I'm gonna talk about that in just a minute. So thank you for that, Cindy. So let me address a few other topics where Gaap has changed. And I'm going to characterize these in a broad umbrella of simplification. Again, if you think about the work that would have gone into and the amount of FASB and ISB staff resources that went into developing those 3 new standards, it was quite significant. And actually, as I said, I was on the board of trustees in that window of time, and we had to ramp up the budget for the FASB, and the FASB hired a lot of new staff to address that. But those weren't the only things the FASB was working on. And as a matter of fact, they had several projects where essentially they saw some opportunity to narrow differences with IFRS and actually simplify US GAAP. So I've given you kind of a short hit list here. First of all, some may be aware, some not. 3 or 4 years ago, the FASB eliminated the concept of extraordinary items. There's no longer an extraordinary item classification on income statements for transactions that are unusual in nature and infrequent occurrence. And we used to record those kind of below the line, right? Like discontinued operations. That's gone from GAAP. And that never existed in IFRS. Secondly, inventory impairments. Over the last few years, the FASB undertook a project to simplify the accounting for lower cost or market. They thought they were going to be able to get to a single model of lower of cost or net realizable value. That's what's used in IFRS. Well, a funny thing happened on the way to finishing that standard. The FASB found out that actually lower of cost or market is a really, really good framework for inventory impairments for LIFO and retail method companies. So the FASB retained LOCOM, lower cost or market for LIFO and retail, inventory methods, but they use lower cost or net realizable value for FIFO and weighted average. So that's actually, the FASB tried to simplify, and they actually ended up making it a little bit more complex. Contributions, we now have new criteria for conditional and unconditional contributions. I think the not-for-profit people on the call know about that. Goodwill, we now have a amortization alternative for private companies related to goodwill. So that's kind of going back to the Gaap we had before, Statement 141 and 142. And for all companies, the FASB simplified the impairment test to eliminate step 1 in the impairment test for public companies. But debt issue costs, we used to record debt issue cost as a deferred cost and amortize it over the life of the debt, usually on a straight line basis. The FASB agreed with the ISB that that really doesn't meet the definition of asset. And so now debt issue costs are adjusted against the carrying value of the debt and amortized over the life of the debt obligation. Two other things, classification of deferred taxes. Again, all deferred tax assets and liabilities now are classified as non-current. That's definitely a simplification change. The companies used to have to go through a little bit of an exercise to net out their deferred tax assets and liabilities and report one deferred tax current, one deferred tax non-current. Now the FASB conformed or converged with IFRS, says, well, they're all non-current. Let's simplify it. And then finally, most recently, the FASB issued with the help of the Private Company Council, an alternative for private companies to measure stock-based compensation. That's a little bit simpler to implement and requiring less heroic estimations of the fair value of stock-based compensation. So a whole set of items there that, depending on when you took intermediate accounting, you may not have been aware that the FASB had worked on these items and made some changes to Gaap in that regard. So what's on the horizons? Well, presently, and this has been affirmed by the new FASB chair, he's been in the seat for about a year now, the FASB has been kind of taking a pause, and they've been careful not to introduce any big projects while companies are still wrestling with implementing these big 3 standards. However, the FASB has issued an invitation to comment, and they're seeking input right now with respect to their agenda going forward. They've identified a couple of places that they think could be good candidates for fairly narrow focused accounting standard setting. One is in the area of performance reporting, and that's really designed to see if there are some consistent frameworks for reporting income that addresses concerns about non-GAAP reporting. And the FASB's done a little bit of work. I mentioned earlier, they implemented a standard on pension cost reporting. That's kind of in the spirit of this project. Secondly, the FASB's looking at and collaborating with the ISB a bit to see if they can simplify the accounting for financial instruments that have debt and equity features. Remember on the earlier slide, you remember IFRS has a different model for accounting for convertible bonds. This has the potential to kind of align US GAAP and IFRS for the accounting for convertible bonds. And then I've identified 3 other narrow projects that are kind of in the research stage right now. That's for development costs. I mentioned that earlier. The FASB might find a way to capitalize more development costs. That's kind of addressing this concern that a lot of people have raised, that balance sheets are missing out on a lot of important intangible assets. And this might be a project to make balance sheets a little bit more relevant in that regard. The FASB has got a kind of a pretty significant study on the accounting for goodwill. And frankly, they're kind of asking whether that private company alternative to amortize goodwill might be something that public companies ought to be able to do. That would definitely be a simplification for US GAAP, because that impairment test has to be conducted every year, and companies have indicated that it's kind of a costly exercise to estimate the fair value of goodwill on an annual basis. And then pretty recently, in the wake of the Tax Reform Act, which kind of had some elements and that were updated in response to the pandemic, there were some revisions made to the accounting for taxes and benefits that companies got from the Tax Reform Act as well as the CARES Act. So again, these projects right now are fairly narrow scope. The FASB again has a invitation to comment out right now to ask people to help them prioritize the projects they might work on next. And again, at present, pension accounting is not making the list. I kind of hoped it would, but everything I'm hearing is that pension accounting is not going to be kind of a priority. Now, the last thing I want to hit before I wrap up is, again, by virtue of being a former trustee for the Financial Accounting Foundation, one of the things I signed on to when I joined the board was to commit to help communicate to people outside of the FASB the work that they do and the resources they have to help people with respect to financial accounting standards. And so I just want to alert everybody, if you want to have a preliminary place to get a link into learning more about these new standards, do not forget about the FASB web portal. They have an implementation link. It's on this slide. You'll see that when it comes out. Or you can just Google FASB.org implementation and you'll find this. You'll see there's some links here to all of these new standards as well as some other items that they've been working on. And those can be really useful to help you do a deeper dive into some of the topics that I've discussed today. So with that, let me hit this last slide. Just to remind you what we talked about. First of all, hopefully I gave you a good overview of where we stand today with respect to international accounting and the fact that convergence really has, the push to converge has really waned, and now the FASB is in kind of a collaboration mode with the ISB. That being said, I hope everybody agrees with me that all professionals ought to have some knowledge about IFRS because it could be important for them and it could give you a peek at where the FASB might be going into the future. Third, I hope I gave you some good overview information with respect to the big three new standards: revenue, financial instruments, and leasing. And both for private and public companies, those elements are being implemented as we speak. And I give you a little bit of information on the FASB's other projects in the spirit of simplification. So hopefully my presentation has been useful and helps you kind of work towards your professional education and goal and achieving your professional education goals here as part of this great association.
Great. Well, thank you so much. What a fabulous presentation. I know there was just such great information and everything. And just a reminder to everybody that we will be sending out the slide deck. We do have, does anybody have any questions? If you do, if you want to raise your hand, I'll be happy to turn the mic on. If you want to, Terry, do you have a minute to take a couple questions?
You can drop something in the chat. I'm watching the chat. Hello, Pat. Thanks for the note. Good to see you online. And I'll do a little cleanup on these slides, Cindy, and send them to you, and you can make them available.
Okay, that would be great. Well, here it looks like there might be. Let's see. Yes. So thank you so much. So Professor Warfield, we can't thank you enough for joining us today, and thank you all for joining us this afternoon and this morning for some of you. So we really appreciate it and hope that you appreciate the member benefit we offered you today. And Professor Warfield, thank you so much. I hope you'll get a chance to come back and speak to our group again.
My pleasure. I'll stay on for a few minutes as needed.
All right, thank you.